15% of Florida home sales are collapsing before the final signature. In Jacksonville, nearly half of listings come back to market after failed deals. Meanwhile, insurance premiums have exploded past $7,500, doubling or tripling in just 3 years, and regulators are scrambling as the state-backed insurer balloons to record risk. Now, entire blocks in Cape Coral and Fort Lauderdale sit half-empty, while buyers retreat in droves. Tonight, the Florida governor is forced into damage control as the real estate bubble bursts faster than anyone imagined. But how did the Sunshine State spiral from boom to unprecedented crisis? The hidden triggers and the consequences are just beginning to surface. April 2023. Behind closed doors in Tallahassee, Florida's top insurance regulators and executives from the state's largest property insurers gathered for an emergency summit. The mood was tense. For the first time since the last housing crash, officials faced blunt warnings that the entire insurance system was on the brink. One regulator, speaking on record, didn't mince words. Affordability isn't just about sale price anymore. In Florida, it's about whether you can even get to the closing table. Around the table, insurers spelled out their demands. Years of mounting losses, runaway litigation, and relentless hurricane claims had pushed many to the edge. Several companies threatened to halt new policies entirely, citing reinsurance costs that had spiked by as much as 50% in a single year. Some, according to meeting notes later leaked to the press, confirmed they would begin withdrawing from the state within weeks. Executives argued that without immediate legislative reform, the private market would collapse, leaving millions of homeowners with nowhere to turn but the state-backed Citizens Property Insurance Corporation. State officials scrambled to draft contingency plans. Internal memos circulated in the weeks after the summit warned that Citizens was absorbing risk at a pace not seen since the 2008 crisis. Behind the scenes, regulators urged lawmakers to act quickly, but the pace of policy withdrawals only accelerated. The message from Tallahassee was clear. Florida's insurance safety net was fraying, and the threat of a full-blown market failure was no longer theoretical. The first cracks in the system were now visible to anyone paying attention. Citizens Property Insurance Corporation was never meant to be the state's primary insurer. By late 2023, that's exactly what it had become. The numbers read like a warning flare. Citizens' policy count hit 1.44 million, its highest level since the aftermath of the last housing crash. Each new policy added billions in exposure, swelling the insurer's total risk to over $640 billion. Internal memos circulated among Citizens executives captured the sense of unease. One flagged the corporation's ballooning book as unsustainable in the event of a major storm, warning that a single catastrophic hurricane could trigger losses too large for Citizens to pay without state or federal intervention. Leadership at Citizens pressed lawmakers for relief, but the pace of growth kept accelerating. The corporation's own risk models, never designed for this scale, were stretched to the breaking point. Staff struggled to keep up with new applications, while actuaries revised their worst-case scenarios upward week after week. Every policy added to Citizens was a policy the private market had refused. By the end of 2023, Citizens accounted for nearly 1 in 5 Florida property policies, a concentration that left state officials deeply uneasy. The corporation's annual statements told the story in stark terms: underwriting losses mounting, reinsurance costs spiking, and solvency ratios approaching redline. One internal communication put it bluntly: if we have another big hurricane year, the system simply can't pay. The safety net designed for emergencies had become the backbone of the market. With private insurers in retreat, Citizens' overload exposed the depth of Florida's systemic risk, long before most homeowners saw the full shock in their next renewal notice. Listings across Florida began multiplying at a pace that startled even seasoned realtors. In the span of a year, the number of homes for sale in key metros tripled, a surge not seen since the last crash. Agents in Orlando, Tampa, and Fort Lauderdale described a steady stream of families and small investors calling to offload properties, each citing a different breaking point: rising taxes, ballooning HOA fees, or the looming threat of unaffordable insurance. The MLS feeds lit up with new entries, day after day, as owners who had once planned to hold for years now rushed to sell before conditions worsened. In Lee County, inventory climbed from just over 4,000 active listings in 2022 to more than 12,000 by the end of 2023. The pattern repeated in Miami-Dade and Palm Beach, where rows of for sale signs began to stretch down suburban streets. Brokers fielded calls from out-of-state landlords, retirees, and working families, all seeking the same thing: a quick exit. The flood of supply overwhelmed buyer demand, transforming what had been a seller's market into a contest for attention. Homes that once vanished in days now lingered for weeks or months, with price cuts growing steeper as the weeks wore on. The numbers told a simple story. In city after city, the supply of homes was outpacing the number of willing buyers. For many, the decision to list was less about timing the market and more about avoiding the next round of cost increases. The rush to sell set the stage for what would come next: a correction in prices that would ripple across the state. The insurance line item has become the breaking point for Florida homeowners. By early 2025, the average annual premium for a single-family home in the state has soared past $7,500. That's more than double what most Floridians paid just 3 years ago. And in some coastal counties, the numbers are even more staggering. Miami-Dade routinely posts quotes above $16,000 for standard homes, while Lee and Collier counties now see $10,000 as a starting point for modest properties. Inland, the pain stretches to Orlando and Jacksonville, where premiums above $4,000 have become the new normal, often for homes far from the nearest shoreline. The culprit is a shrinking pool of insurers. Since 2018, more than 20 major carriers have either collapsed or pulled out of the Florida market entirely, with the pace of exits accelerating after 2023. Each withdrawal sends shockwaves through the rate filings, forcing the remaining companies to shoulder more risk and pass those costs directly to policyholders. Rate filings submitted to the state's Office of Insurance Regulation show double and triple-digit increases year over year, with some zip codes flagged for even sharper jumps due to storm exposure or litigation history. For many families, the premium spike isn't just a budget concern, it's a deal-breaker. Buyers who thought they'd cleared every hurdle now face a final, sometimes insurmountable cost at the closing table. The urgency is real. Lenders have begun demanding proof of fully paid insurance before they'll fund a loan. And even a small gap or last-minute rate hike can kill a deal. In this environment, the question isn't just whether you can afford a home, but whether you can afford to keep it insured. Lenders across Florida are rewriting the rulebook. In 2025, no mortgage funds are released until buyers prove every dollar of insurance premium is paid in advance. The old days of binding a policy at closing are gone. Now, underwriters comb through insurance binders, line by line, searching for gaps that could kill a deal before it leaves the starting gate. Mortgage officers describe a new gauntlet. Borrowers must show not just a quote, but a receipt, often for premiums topping $7,500, sometimes more than $16,000 in Miami-Dade. If the policy can't be secured, the transaction dies. No exceptions, no extensions. The numbers tell the story. Statewide, nearly 15% of pending home sales fail to close, a rate that dwarfs national averages. In Orlando, Fort Lauderdale, and Jacksonville, 1 in 5 deals unravels before the keys change hands. Jacksonville stands out. Almost half of all listings have cycled back to market after a failed contract, each one a casualty of last-minute insurance breakdowns or lenders refusing to fund uninsured homes. Local mortgage teams report a steady drumbeat of cancellations. Some buyers scramble to switch carriers days before closing, only to discover that no insurer will write a policy at any price. Others are blindsided when a lender's underwriter demands proof of paid coverage, not just a binder, forcing families to walk away from deposits they spent months scraping together. The mechanism is simple but ruthless. No insurance, no loan. No loan, no sale. In this environment, the insurance crisis isn't just a cost issue. It's the fulcrum on which Florida's entire real estate market now balances. Contracts are unraveling in every corner of the state, but the fallout is most visible at street level. In Jacksonville, the numbers are stark. Nearly half of all active listings have been relisted after failed deals. For brokers, it's become routine to see the same property cycle through the MLS 2 or 3 times in a single season. One agent describes a week in which every other contract fell apart, often after buyers discovered their insurance quotes had jumped by thousands overnight. In Tampa, a young couple watched their dream home slip away when the premium they budgeted at $3,500 was suddenly revised to $7,800. The lender wouldn't close. Their deposit, months in the making, vanished with a single email from the underwriter. Stories like these are multiplying. In Fort Lauderdale, a retired couple lost their loan approval after their insurance quote spiked $4,000 in a weekend. The seller relisted the condo within days, joining a growing backlog of homes that simply can't find buyers willing or able to clear the insurance gauntlet. Local mortgage officers describe a steady stream of heartbreak. Families walking away from contracts. Sellers forced to drop prices. Buyers blindsided by costs they never saw coming. The numbers and the names change, but the pattern is the same. Deals that look solid on paper collapsing in the final stretch, leaving everyone involved scrambling for answers. The statistics are cold, but the reality is deeply personal. Behind every failed closing, there's a family recalculating their future and a seller left holding the keys. Whistleblowers inside Florida's insurance sector are pulling back the curtain on a crisis that runs deeper than canceled policies and rising premiums. Independent adjusters once tasked with assessing hurricane damage and routine claims now describe a work environment shaped by pressure and retaliation. In sworn testimony filed in federal and state courts between 2022 and 2025, adjusters allege they were directed to reduce loss estimates and deny legitimate payouts, sometimes by as much as 80%, regardless of what their field inspections showed. Jennifer Klossner, a senior desk adjuster at Heritage Property and Casualty, detailed in her deposition how management instructed her to eliminate entire categories of water damage. When she questioned these orders, she was locked out of company systems and fired within weeks. Her case, documented under U.S. District Court Docket 8:22-CV-01584-CEH-SPF, includes emails from supervisors. "We cannot afford to keep opening claims for full roof replacements." Daniel Ramos, another adjuster, filed an EEOC complaint after his employer, Universal Property and Casualty, edited his reports to lower settlement amounts. He describes being demoted, reassigned, and then terminated after escalating his concerns to both HR and state regulators. Internal chat logs submitted as evidence revealed directives like, "Just revise all the roof claims to 30% damage. We're not approving more replacements this month." Termination logs obtained through legal discovery show a pattern. Multiple claims staff who raised objections were dismissed within a single quarter. The Florida Office of Insurance Regulation, under oath in 2024 market hearings, confirmed receiving testimony from more than a dozen former employees at 5 separate carriers describing similar practices. Insurers, for their part, deny wrongdoing, citing business necessity and broader market pressures. Yet the official record now contains dozens of affidavits, deposition transcripts, and internal memos pointing to a system where claim suppression and retaliation are not isolated incidents, but recurring features. For homeowners and buyers, the result is a market where trust is in even shorter supply than affordable coverage. By mid-2025, Florida's housing market is in free fall. The statewide median home price has dropped to $390,000, a $55,000 slide from the previous year's peak. In cities like Punta Gorda, the pain is even sharper. Year over year, median prices have tumbled more than 14%. For sellers who bought at the height of the pandemic boom, the loss isn't just on paper. Many now owe more on their mortgages than their homes can fetch on the open market. Brokers describe a landscape where price cuts are routine and once rare negative equity is becoming the norm. Inventory tells its own story. Listings that once sparked bidding wars now linger for weeks, sometimes months, as buyers hesitate or walk away. In Lee County, the number of homes for sale has tripled since 2022. Agents report entire blocks in Cape Coral and Naples, where every other house sports a for sale sign, each one a silent witness to the sudden reversal in fortunes. The oversupply is relentless. New entries flood the MLS every day, while existing listings drop prices again and again in search of a willing buyer. For owners, the math is unforgiving. A house purchased for $445,000 in 2023 may now be worth $390,000 or less, with no guarantee of a quick sale. The rush to exit is fueling a self-reinforcing cycle. More listings, lower prices, and deeper losses for those who can't afford to wait. As one Punta Gorda seller put it, "We're all just hoping to get out before the next price cut lands." Condo owners across Florida are facing a new kind of bill, one that arrives not from lenders or insurers, but from their own associations. Senate Bills 4D and 154, passed in the wake of the Surfside tragedy, require every condominium building taller than 3 stories to fund reserves for structural repairs. The deadline is December 31st, 2025. The numbers are staggering. In Miami-Dade and Broward, residents have opened their mailboxes to find assessment notices demanding $48,000 due within 90 days. Some buildings have gone even higher, with lump sums pushing $80,000 per unit. The impact is immediate and deeply personal. Rose, a 72-year-old retiree in Hallandale Beach, found herself staring at a bill for $48,000. Her fixed income couldn't stretch that far. She sold her car, emptied her savings, and turned to neighbors for help. Some organized a fundraiser, others put their units up for sale, unable to see a way forward. The choices are brutal: pay the assessment, sell at a loss, or risk foreclosure if the board files a lien. For families, the squeeze is just as severe. A single mother in North Miami described choosing between covering the special assessment or keeping up with her mortgage. With no payment plan offered, she faced the prospect of losing her home. Across the region, legal hotlines are flooded with calls. Lawsuits have erupted over how boards select engineering firms, accusations of conflicts of interest, and complaints that some contracts were handed out without competitive bids. Judges in Broward and Palm Beach have already issued injunctions in cases where owners allege the process was rushed or opaque. The new reserve mandates were designed to protect residents from future tragedy, but for thousands, they have delivered a financial shock that rivals any hurricane. The bills keep coming, and for many, the math simply won't work. Mortgage officers across Florida describe a gauntlet that few borrowers can survive. In 2025, the interest rate on a standard 30-year loan hovers near 7%, pushing the monthly payment on a $400,000 mortgage from $1,350 just 4 years ago to almost $1,900 today. And that's before insurance or homeowners association fees. For many buyers, the numbers simply don't add up. Debt-to-income ratios breach safe limits, and underwriters flag files for rejection long before closing. The appraisal gap is another silent killer. In Orlando, it's become routine for appraisals to come in $30,000 below contract price, forcing buyers to either cough up the difference in cash or watch the deal collapse. Some try to renegotiate, but with sellers already slashing prices and inventory piling up, patience is wearing thin on all sides. Mortgage teams report that even well-qualified buyers are walking away mid-process. The risk of overpaying, coupled with the shock of rising payments, has turned enthusiasm into anxiety. Lenders are now demanding full documentation of paid insurance, reserves, and every penny of closing costs. If a single piece is missing, the loan is dead on arrival. The message from the financing desk is blunt. The era of easy money in Florida real estate is over. Every deal is a high-wire act, balancing rising rates, shrinking appraisals, and the constant threat that the numbers will fall apart before the ink is dry. As buyers retreat, the next wave belongs to those with cash or the nerve to gamble on further declines. Court dockets across South Florida are filling with lawsuits as condo owners and board members turn against each other. In Miami-Dade, Broward, and Palm Beach, the legal battle lines are drawn over who shoulders the blame and the bill for the financial shock of new reserve mandates. Attorneys representing owners accuse association boards of bypassing competitive bidding, hiring friendly engineering firms, and rushing multi-million-dollar contracts through without proper oversight. Judges have already issued injunctions in several high-profile buildings, halting special assessments after owners alleged conflicts of interest or procedural violations. One case in Broward County centers on a 200-unit tower where the board awarded a $12 million repair contract to a firm run by a board member's relative. Owners, blindsided by a $60,000 assessment, filed for an emergency injunction and demanded a forensic audit. In Palm Beach, a class action suit alleges that the board concealed the true scale of structural deficits until the last possible moment, leaving residents with no time to prepare or sell. Court records show a spike in these filings since late 2024, with more than 100 new cases logged in Miami-Dade alone by mid-2025. Judges now find themselves refereeing disputes over everything from payment plans to the selection of reserve study vendors. The legal wrangling has left many associations in limbo, unable to move forward with repairs or collect needed funds. For thousands of owners, the courtroom has replaced the boardroom as the last hope for accountability, and the uncertainty threatens to stall recovery efforts across some of Florida's most vulnerable coastal communities. Institutional investors are making a quiet exit from Florida's housing market. In metro areas like Fort Lauderdale, Orlando, and Cape Coral, the number of investor-owned listings has doubled since 2023. The trend is unmistakable. MLS feeds fill with properties once held by Wall Street landlords, now dumped in bulk as holding costs outpace returns. Local agents describe a steady stream of portfolio disclosures, funds offloading dozens of homes at a time, sometimes entire blocks, to cut their losses before further price drops wipe out remaining equity. In the words of one Miami broker, "The big money is gone. They're not waiting to see how low it goes." Builders are also pulling back. In Lee and Broward counties, permit records show a sharp drop in new construction filings since late 2024. National developers, once racing to meet pandemic-era demand, are now pausing projects midstream. Subdivisions that broke ground in 2023 stand half-finished, with rows of empty homes and construction equipment gathering dust. Quarterly reports from major builders like D.R. Horton and Lennar cite Florida as a drag on national starts, with official statements referencing market risk and unsold inventory as reasons for delays and cancellations. In Cape Coral and Fort Lauderdale, entire neighborhoods have become ghost developments, blocks of vacant or for-sale homes, with local governments facing shrinking tax rolls and residents left to wonder if amenities will ever arrive. The retreat isn't limited to new builds. Some developers are offering steep incentives just to move existing inventory, slashing prices on unsold homes or converting projects to rentals. But even deep discounts can't offset the headwinds: spiking insurance, flatlining rents, and a buyer pool that keeps shrinking. The result is a landscape where capital that once fueled Florida's rapid growth is now in full flight. The numbers tell the story. Investor listings up 100%, new permits down more than 60% in Lee County, and a growing patchwork of neighborhoods where construction has simply stopped. The withdrawal of big money leaves a vacuum, setting the stage for the next act in Florida's housing unraveling. Cape Coral, August 2025. The numbers are staggering, even by Florida standards. Active listings in the city have jumped 35% in just 12 months, flooding the market with more than 12,000 homes for sale, 3 times the inventory seen just a few years earlier. The median sale price has tumbled nearly 10% year over year, wiping out gains from the pandemic boom and pushing thousands of recent buyers underwater. Negative equity is no longer a rare event. Brokers report entire neighborhoods where owners owe more than their homes are worth, some for the first time since the last housing crisis. On the ground, the mood is anxious and raw. Local real estate offices field desperate calls from sellers who bought at the peak and now face losses of $50,000 or more if they sell today. One broker, with 30 years in the business, calls it the worst market he's ever seen. We have clients walking away from deposits, investors dumping properties, and families who just want out. There's no playbook for this, he says, voice tight with frustration. The city's glut of unsold homes is matched only by the sense of disbelief among residents. Streets once lined with moving vans and fresh landscaping now display a parade of for sale signs, some faded from months in the sun. In new subdivisions, half-built houses sit idle, construction crews long gone. The overhang of supply is relentless. Each week brings new listings, deeper price cuts, and more sellers forced to confront the reality of negative equity. State officials can no longer downplay the crisis. At a tense press conference in Tallahassee, the governor faced the cameras and admitted, "We never expected it would get this bad this fast." The statement landed like a thunderclap, confirmation from the top that Cape Coral has become the epicenter of Florida's housing collapse. Internal risk studies, once quietly circulated among lawmakers, now dominate the headlines. Cape Coral ranked #1 in the nation for risk of further decline, with analysts warning that the city's rapid inventory surge and price drops have set off a chain reaction of distressed sales, failed contracts, and abandoned projects. Local agents say the market has turned on its head. Where once buyers competed in bidding wars, today sellers compete for attention, sometimes slashing prices by tens of thousands and still finding no takers. The sense of urgency is palpable. For many, the only question left is how much further things can fall before relief arrives, if it ever does. Policy analysts across Florida are now wrestling with the question of what comes next. In legislative hearing rooms and university roundtables, the debate is shifting from crisis response to long-term stabilization. For some, the answer lies in expanding risk-sharing pools, public-private partnerships designed to lure new insurers back into the market. Lawmakers are weighing proposals to further reform litigation rules, cap attorney fees, and streamline claims processing, hoping to curb the runaway legal costs that helped drive so many carriers out in the first place. Others argue for direct state intervention, subsidized reinsurance, targeted grants for hard-hit homeowners, and even the creation of a new catastrophe fund to backstop future hurricane losses. Economic experts point to early signs of stabilization. In 2026 forecasts, several see a gradual plateau in insurance premiums as legislative reforms begin to take hold and new carriers test the waters in select counties. A handful of companies have filed for entry, encouraged by changes to claims statutes and the promise of state support if another major storm strikes. Yet the optimism is cautious. Many warn that any recovery will be fragile, easily derailed by a single catastrophic hurricane or a resurgence in litigation. The specter of another wave of insurer withdrawals still hangs over the market, and there is little consensus on how to balance consumer protection with the need for a viable insurance sector. The risk-sharing debate is particularly heated. Some policy architects advocate for a model similar to the federal flood insurance program, spreading losses across a broader base and reducing the exposure of any single company. Others question whether such an approach can work in a state as exposed as Florida, where climate risk is rising and global reinsurers remain wary. Legislative staff are drafting bills that would require more transparent reporting from both insurers and condo associations, aiming to restore public trust and attract capital back to the state. At the same time, consumer advocates push for hardship relief, calling for targeted assistance to elderly and low-income homeowners facing assessments and premium spikes they simply cannot pay. With so many competing interests, the path forward is anything but clear. The only consensus among analysts is that the old model, relying on a shrinking pool of private insurers and a state-backed safety net stretched beyond its limits, cannot hold. The next chapter of Florida's real estate story will be written in the halls of the legislature, the offices of regulators, and the boardrooms of insurers. Whether the state can strike a balance between affordability, access, and solvency remains the central question as 2026 approaches. By mid-2025, Florida's state-backed insurer, Citizens, managed 1.44 million policies, its highest level since the last housing crash. Insurance premiums now average over $7,500, and more than 20 major insurers have exited the state since 2018. Nearly 15% of home sales failed statewide in the past year, as lenders demanded proof of costly insurance and buyers struggled with 7% mortgage rates. Cities like Cape Coral saw inventory jump 35% in just 1 year, with prices falling nearly 10% and negative equity spreading fast. Yet many questions remain. How many more condo owners will face unaffordable special assessments as new reserve mandates take effect? Will reforms stabilize the insurance market, or will more carriers leave? The evidence is clear. Florida's housing market faces a historic reckoning rooted in insurance instability, rising costs, and new legal pressures. As one regulator warned in 2023, affordability isn't just about sale price anymore. Florida's real estate future now depends on how leaders, insurers, and residents respond to these unprecedented challenges.